The history of bull and bear markets. The terms bull market and bear market have been used for centuries to describe the direction of financial markets. These terms capture the emotional and economic cycles that investors experience, and their origins are rooted in both historical trading practices and the behavior of the animals they are named after. Why bull and bear? The bull and bear metaphors come from how each animal attacks its opponent. A bull thrusts its horns upward, symbolizing a market that is rising. A bear swipes its paws downward, symbolizing a market that is falling. These vivid images became shorthand for optimism, bullish, or pessimism, bearish in the markets. Historical origins. The term bear market is older than bull market. In the 1700s, traders in England would sell bear skins they didn't yet own, expecting to buy them later at a lower price. This speculative selling became known as selling the bear, referring to selling something in anticipation of falling prices. Eventually, bear came to represent declining markets. Bull market likely developed later as the natural opposite of the bear, tied to the idea of optimism and upward movement in prices. Definition of bull and bear markets. Bull market is a period when prices are rising or expected to rise, typically by 20% or more from a recent low. It reflects investor confidence, strong economic indicators, and rising demand. A bear market is the opposite, a period when prices fall 20% or more from recent highs, often triggered by economic downturns, crises, or negative investor sentiment. These cycles are a natural part of the stock market and can last for months or even years. Notable bull markets post-Great Depression boom, 1940s, 1960s. Following World War II, the U.S. economy surged, and so did the markets. 1982-2000 bull market, one of the longest in history, driven by technology and economic expansion. 2009-2020 bull market. After the 2008 financial crisis, markets rebounded and climbed steadily for over a decade. Notable bear markets: the Great Depression, 1929-1932. One of the worst bear markets, with the Dow Jones losing almost 90% of its value. 2000 dot-com crash, overvalued tech stocks crashed, leading to a major market downturn. 2008 financial crisis, triggered by the collapse of the housing market and banking system. COVID-19 bear market, 2020. A rapid but short-lived bear market caused by global shutdowns. Why these terms still matter? Bull and bear markets are more than just labels. They help investors understand market trends, assess risk, and guide investment strategies. While bull markets bring excitement and opportunity, bear markets remind investors to stay cautious and diversified. In summary, the bull and bear market terms come from old trading slang and the natural behaviors of two powerful animals. Over centuries, they've come to symbolize the emotional and financial ups and downs of investing. Though unpredictable, both are essential parts of the market cycle, and each prepares the ground for the other.